We're breaking down the financial performance of Bukit Darah PLC, a company that recently posted some truly eye-popping numbers.
165%. That is the year-over-year profit growth for Bukit Darah. Let that number sink in for a second.
But a number like that, it can be misleading, right? So we have to ask, is this profit actually real? Is it sustainable? And what's really driving it?
Okay, just a quick heads up. This is fundamental analysis for educational purposes. It is not financial advice. All right, let's dig into that profit surge and look beyond the headline number. So the first thing you notice is that this isn't just a bottom line story. The growth is all the way down the income statement. Revenue's up a solid 17%, but then, as you go down, things just accelerate. Gross profit, up 31%. Operating profit, a whopping 62%. And that all leads to that incredible 165% jump in net profit. So what does that tell you? It tells you they weren't just selling more, they were making more money on everything they sold.
And this chart on margin expansion really drives that point home. I mean, look at these jumps. The net margin more than doubled, going from just over 2.5% to nearly 6%. This isn't just simple growth. This is a company becoming fundamentally more efficient and profitable at its core.
Okay, but here's the big question, right? Is this real operational profit, or is it just some accounting wizardry? Well, they did report over 3 billion rupees in fair value gains. You can think of those as paper gains. But, and this is the crucial part, that's only about 9% of their profit before tax. The other 91%, that came straight from strong core operations.
So where did all that operational strength actually come from? Well, it turns out the answer lies in their three main business pillars.
Bukit Darah's success really rests on these three pillars, and in this period, they were all firing on all cylinders. You've got oil palm plantations, their biggest profit engine, with revenue up 19%. Then the beverages segment, profits there jumped 26%, mostly thanks to international sales. And check this out, the oils and fats business was the real growth superstar, with profits soaring an incredible 74%. It was just a perfectly coordinated surge across all their main businesses. But, it wasn't all perfect, and this is an important detail to catch. Their much smaller leisure segment, it actually posted a loss. Now, it was because they were refurbishing hotels, so it's understandable, but it's a great little reminder that you always have to look at the whole picture, not just the shiny highlights.
So, even with that small loss in leisure, the big picture is incredibly strong. We've confirmed the profit is real, it comes from core operations, but now we get to the most important test of all. The ultimate question, did all that profit actually turn into cold, hard cash? And to figure that out, we use a metric called the cash conversion ratio. It's super simple but incredibly powerful. It just asks, how good is a company at turning its reported profit into actual cash from operations? Anything over 1.0 is considered really, really strong.
And Bukit Darah, their cash conversion ratio was an absolutely exceptional 1.17x.
Just stop and think about what that number means. For every single rupee of profit they reported on their income statement, they actually generated more than a rupee in real cash. This is the definition of high-quality earnings. This isn't some accounting fiction. This is a cash-generating machine, plain and simple.
So what happens when a company generates that much pure cash? Well, it builds an absolute fortress of a balance sheet. Let's take a look at the end result of all that high-quality profit.
Okay, this is pretty remarkable. On one hand, you have over 72 billion rupees in cash. On the other, their total debt, all of it, short and long term, is less than that. This puts them in a position we call net cash positive. It means they could literally wake up tomorrow, pay off every single penny of debt they owe, and still have cash in the bank. That's incredible financial strength.
And that financial strength, it translates directly into real value for shareholders. Just look at the net asset value per share. Think of it as the company's book worth on a per-share basis. It jumped by a massive 17%. In just 6 months, that's tangible wealth creation, right there.
And one last check on their financial health, liquidity. Their current ratio is 2.24. All that really means is they have more than 2 rupees in assets ready to go for every 1 rupee's bills they have to pay soon. It's just another sign that this company is rock solid.
So after digging through all of this, what are the big lessons? What are the key takeaways from this analysis of Bukit Darah's amazing performance?
Okay, there are 3 crucial lessons here that you can apply to basically any company you analyze. First, always verify profits with cash flow. Check that cash conversion ratio. Is it over 1? That's your quality check. Second,
Isolate the core operations. You've got to strip out any of those paper gains to see the real repeatable strength of the business. And third, assess the financial strength. That net cash positive position, that's the gold standard. It gives a company incredible strategic flexibility.
And that really brings us to the final thought here. You have a company that's incredibly profitable, it's swimming in cash, and it's practically debt-free. So the question for Bukit Darah is no longer about survival or stability. The question is now about strategy. With a balance sheet this strong and cash flow this powerful, what do they do next?